Welcome back to the Bitcoin Fortress Podcast, episode 177, recorded here on August 17th, 2025. We're at block height 910479. Moscow time is 8:48. Fees are 1, 1, and 2. As promised, or maybe as I suggested, I'm redoing the podcast to be Bitcoin only, no distractions, no more fiat market stuff, no more shit coins, just Bitcoin. So today we're going to talk about state and corporate adoption, retirement policy, DC supervision shifts, AI mining tie-ups, some on-chain realities, including that 80,000 Bitcoin transfer, India's policy momentum, physical world OPSEC, and a grounded take on quantum. Plus, of course, I'll mention our weekly Substack featured post and a quick plug for my book. So let's dive right in. First, we'll talk about United States states building Bitcoin reserves. So, in the news, Texas formally created the Texas Strategic Bitcoin Reserve via SB 21. That established a special fund under the state comptroller with authority to buy, manage, and custody Bitcoin outside the Treasury with its own reporting and advisory committee. New Hampshire, of course, separately enacted HB 302, allowing its treasurer to invest public funds in precious metals and digital assets with up to or greater than 500 billion market cap. So that would only basically be Bitcoin today. Arizona set up a reserve fund for unclaimed crypto, which is distinct from investing state cash, while a bolder strategic reserve proposal there was vetoed. So for Texas, the reserve is a special fund outside the state treasury, so inputs can include legislative appropriations, dedicated revenue, assets purchased into the fund, and investment earnings. The comptroller may contract qualified custodians and liquidity providers. There's biennial public reporting, and there's no claim in the statute about oil, gas, royalty earmarks or anything like that, but they're basically buying Bitcoin. In New Hampshire, that HB 302 permits the treasurer to allocate a slice of public funds into digital assets only if they're mega cap, which is basically Bitcoin only. It's investment authority, not a mandate. And then you have Arizona, which that law focuses on unclaimed virtual currency held by the state, custody management versus the new taxpayer purchases. And then, of course, a separate strategic reserve bill used seized assets, and that was vetoed. So we're expecting more bills to iterate. So basically, states are normalizing Bitcoin inside public finance plumbing, including custody, reporting, and audits. And even modest allocations force institutional grade custody and governance patterns that private treasuries can copy. So, a lot happening there on the state front. As far as corporate treasuries, MicroStrategy, now branded Strategy, continues to add Bitcoin. Smaller weekly buys lately, but still sits as the largest corporate holder. Media and analyst notes again highlighted that MicroStrategy's equity trades at a persistent premium to its Bitcoin NAV. And of course, the drivers for that include leverage, options, market access, and passive flows. Several breakdowns peg a 20 to 30% premium, which fluctuates versus the value of underlying Bitcoin because equity markets confer credit and optionality that spot Bitcoin ETFs don't. Public company Bitcoin tallies keep climbing across miners and a handful of tech names. The story is balance sheet normalization, not headline buys. Um, Corporate treasuries chase capital structure advantages and investor signaling. States are codifying public sector governance and custody, different incentives, but the same endpoint, hodling at institutional scale. So, stepping back from the forest for the trees, the state and federal and institutional adoption continues. And that's really the trend that we're seeing. And hopefully they have diamond hands, unlike Germany, which had paper hands last year and sold their 50,000 Bitcoin. On August 7th, the White House issued an executive order to open 401ks to alternative assets, explicitly including cryptocurrency and directing the Department of Labor and Treasury to produce safe harbor guidance for fiduciaries. Mainstream outlets and the order itself confirmed the shift, so we can expect multi-year implementation, not same-day access. So this is going to take some time. But just for an understanding of scale, in the United States, 401k assets add up to somewhere between 9 and $12 trillion. So even a 1% penetration is material. But again, don't expect that in year one. Fiduciary reality is that litigation fear kept plan sponsors sidelined. So with a clear safe harbor, you have an unlock. Still, I think you can expect gating, approved products, caps, default option rules, etc. The timeline is that the DLL guidance and record keeper plumbing and target date fund infrastructure and diligence on custody will be very slow. So this is just a door opening, not a stampede, and it could take years for there to be meaningful purchases by 401k plans of Bitcoin or alternative assets, private equity. There's also an article I saw recently that the private equity is just an unlock for the private equity firms to dump their bags on the poor normies that have 401k assets. So maybe steer clear of the private equity shitcoins and just buy Bitcoin. Little whiplash from Scott Bessent's strategic reserve messaging in the news. In some interviews last week, Treasury Secretary Scott Bessent said that the U.S. isn't buying additional Bitcoin beyond seized coins. And then the market dipped. And then he clarified later that budget neutral pathways to add more are still on the table, which sent, of course, mixed signals. And that was all captured by mainstream and policy outlets. So what's actually said is that they're building the Federal Reserve via seized coins. They're stopping the auctions. They're exploring no taxpayer cost ads like swap programs, fees, or other offsets. And of course, this matters because the concept of a U.S. strategic Bitcoin reserve is now policy mainstream. The debate is really how to fund it and not whether Bitcoin belongs. And that is really what matters. Looking at AI and Bitcoin mining, there's been some real deals, not hype. So TeraWulf inked two 10-year AI hosting contracts with FluidStack totaling $3.7 billion, extensions up to $8.7 billion revenue, deploying 200 plus megawatts at its New York sites. Google is backing FluidStack's lease obligations and received warrants equating to 8% of TeraWulf. The stock, of course, ripped on the news. So this is really dual use infrastructure now. So miners can swing compute between Bitcoin security and AI inference training, which is deepening the revenue resilience without abandoning mining. The value to the grid is that curtailable mining plus schedulable AI stabilize the load, and that can help depoliticize the energy narratives. Although, admittedly, Bitcoin mining is much more flexible. It could be shut down at a moment's notice and restarted, whereas the AI compute can never go down. It needs to be always on, and it is hungry for energy. The concentration around mega sites, though, is a bit of a concern, but the home miner decentralization remains a separate priority. Everybody should run a node and plug in a little BitX in your house, is sort of my opinion. But again, the CapEx flywheel benefits the network and long-term security, so that's something that we like to see. Next, The Fed just scrapped its crypto special unit. On August 15th, the Federal Reserve said it will shut down its 2023 Novel Activities Supervision Program that singled out crypto and fintech in bank oversight, and instead fold those reviews back into regular supervision. That's a tone shift from special scrutiny to business as usual plus risk based. Banks will still need robust risk frameworks, but the optics do improve. Crypto isn't an alien activity anymore, so we've got clarity versus via normalization. And of course, big custody banks, Fidelity, State Street cohorts, will likely lean in. Risk averse regionals, though, may sit tight. And of course, this will ease the path for bank grade custody and settlement, but like all the other things, doesn't guarantee a rapid rollout. So it's bullish, but it's probably going to take a while for this to work its way through the banking system. But clearly, the banks want to make money off of crypto, Bitcoin, and so they are highly motivated to get in the game. And so that's always that's always going to push them along. Taking a look at on-chain reality, uh, long-term holders are strong, but churn is real. Galaxy Digital recently disclosed it executed about an 80,000 Bitcoin notional transaction for a Satoshi era investor, an estate, one of the largest in history. And then, of course, immediately after that, debates flared about OGs losing faith, but the data context is distribution, not collapse. It's normal. So long-term holders are not statues. They do move and sell every mid-cycle for estates, liquidity, diversification. That doesn't negate the broader illiquid supply uptrend. Um, Not sure what they're buying, but I hope they make more money than they did in Bitcoin. That's all I could say. And I doubt that that's going to happen, but you never know. As far as exchange flows, modest net inflows recently are normal at this stage. The liquidity provision, recollateralization, not clear-cut bearish. And of course, what matters most is that illiquid supply share and days destroyed trends, which are not off of whale prints. So you have to pay attention to what's really happening, which is continued adoption. And of course, we do still have market cycles. There is accumulation followed by distribution. And, you can expect there to be drawdowns along the way and maybe some really bad ones too. That's part of being a hodler. And so, really, your mindset is let's take advantage of the downturns to accumulate more coins. And then let's just hang on and not get crazy when the price blows up. Just stay humble. Next, out of India, there's some concrete policy momentum uh, uh, with on August 15th, which is, I guess, India's Independence Day. The Bitcoin Policy Institute of India publicly launched. This is an explicitly Bitcoin only think tank aimed at research and policy education for officials and the public. This follows India's clear tax framework, 30% on gains, 1% TDS, and normalized banking access for exchanges. Creating a domestic policy knowledge base to brief ministries, courts, and regulators with Bitcoin specific, not crypto general research is, of course, critical and is a great sign to see in that market. Of course, India being the number one remittance market with small percentage adoption, it could be a giant absolute number of users if they do pivot towards Bitcoin. And education plus lawful rails are the flywheel for that. State level pilots, payments, energy backed mining, and more precise KYC AML harmonization are the most likely next steps as a result of this, but a pretty big deal there. Next, we'll touch on OPSEC. Kidnappings and wrench attacks are up. So Alina Vranova from Satoshi Labs warned at the Baltic Honey Badger 2025 that, quote, at least one Bitcoiner a week is kidnapped and assaulted for their keys, including cases over as little as $6,000 worth of Bitcoin. She links the vulnerability to KYC data leaks and is piloting Glock, GLOK, not the gun, an encrypted distress signal app over Nostr, which is pretty cool and interesting. Um, so here are the takeaways. Number one, get off exchanges for savings. Use them like an airport, not a hotel. Multisig with geographically separated keys. Consider decoy accounts and duress protocols. Yes, you have to plan ahead for this. It could happen. Keep a low profile. Don't broadcast your stack size. Sanitize your social media and practice home address hygiene. And as much as you want to wear that Bitcoin hat or that Bitcoin shirt, think twice about it. It's one thing at a conference, it's another thing day to day. Don't be a billboard. And then finally, crisis prep. Make sure, and you should always have a plan for your home for crisis anyway, but make sure the family has code words, canary check-ins, a trusted circle that knows not what not to do. So again, OPSEC back in the news, very important. Keep a low profile. That's part of staying humble. Next up, we'll talk a little bit about quantum without the FUD. So there's been a run of recent explainers and research pieces that resurfaced some quantum risk headlines. Meanwhile, NIST finalized PQC standards. This is FIPS 203, 204, and 205 last year, and continues adding algorithms, HQC in 2025. And Bitcoin dev circles have been mapping upgrade paths, so let's separate reality from panic. First of all, there's no public proof of a machine that could break ECDSA at Bitcoin scale today. Timelines span years to a decade plus. Headlines often compress that. Again, that makes things a little bit more exciting for a reader. Standard bodies like NIST have issued quantum resistant signature encryption standards. Bitcoin devs can soft fork in a new script path when warranted. Multisig taproot already reduce exposure of unused public keys. What's important, I think, for you all is to use modern wallets, so avoid address reuse. Most of the modern wallets always give you a fresh address every time you're sending or receiving. And lean on multisig because, again, it's a lot harder to crack 2 of 3 than it is to crack 1 of 1. And watch for PQC ready wallet support when it arrives. I think the story here is be prepared, but don't be a doomer. And let's not forget, there's lots of other stuff that relies on cryptography that's going to be in a freak out before the Bitcoin hodlers will. Let's talk about government. Let's talk about the military. Let's talk about the banks. All of them use cryptography that would fall in the face of quantum. Did want to feature this week's Bitcoin Fortress Substack articles entitled Bitcoin and the Future of Estate Planning, Practical Steps for Multi-Generational Key Management. We'll include a link in the show notes to this and all of the other content that I covered, so check it out. If you like it, please subscribe. It's free. And if you really like it, you can become a paid subscriber. I also want to mention my book, Bitcoin Fortress, A Simple Guide for Beginners. It's a concise primer you can hand to a friend or a family member, and we'll include a link as well in the show notes. And that about wraps up episode 177. We covered real policy, real infrastructure, real risks, and why Bitcoin keeps getting more ordinary inside the world's most serious institutions. With that, stay humble, stack sats, fortify your fortress. We'll talk to y'all next week. Bye bye.